folks. Don't forget, we'll also be taking on board your questions and queries. So if you have any questions on your mutual fund portfolio, on funds you own, or even if you want to kickstart your investment journey now, keep them ready and write into us on the Money Show at etnow.tv, or you can call in live in just a couple of minutes from now. We will be getting your questions answered right now on the show. And to take us through all of this, I am joined today by Uday Dhoot, the co-founder of Ven Wealth from Bangalore. Hi Uday, always a pleasure having you with us on the Money Show. So Uday, the topic that we thought we'll take up today, especially because there's been a new NFO as well that has come about in the very same theme, that's international funds or domestic global funds. As the name suggests, it does have an exposure to global markets, to global stocks in certain ways. So basically, if I buy a domestic global mutual fund unit, I will also be buying stocks abroad. Just explain to our viewers, what exactly does it mean? What sort of return expectations could they have? What does a domestic global fund do to one's overall portfolio? Uday.
Hi, thank you. So I think the biggest reason why anyone needs to think about global investing is basically the idea of diversifying away from one single economy risk, one single country risk, one single country political risk. Over the course of last 7-8 months, just before the elections, we were awaiting with abated breath sort of what is likely to happen, which government is going to come, how the markets will react. Now essentially, to do away with these kind of specific country risk, you need to think about international investing.
Let's take a break.
Now, for investors in India, there are basically two ways that Indian investors can invest abroad. One is using something called the liberalized remittance scheme, by which you can basically transfer money outside India and then invest wherever you feel like buying properties and so on and so forth. And the other is basically investing in international stocks or commodities through domestic mutual funds, wherein the mutual funds essentially take your money locally and then take that money and invest in global companies or commodities outside India. Now, why should be doing that, or why should anyone be doing that? Is that one, there are basically 3-4 different reasons why one should be doing that. Like I spoke, the first thing is you do away with the single country and economy risk, single politic risk as such. Second, it widens your possibilities of investing in some of these global companies which you are otherwise using their products but do not have access to. Take example, Google, Amazon, Microsoft, Facebook, and so many such companies which you are otherwise using, like their product, Apple, but you are not able to invest in them. So these funds can actually invest in these companies, which are very large companies doing a lot of innovation, and you can basically invest in them. And the third is that you basically diversify your currency risk. All your money today is lying in Indian INR. If you're investing abroad, you basically hedge your currency risk. For somebody who is thinking of sending kids for education abroad, then this is a great way to hedge your risk and basically have some investment sort of going in another country outside of India. So these are your basic reasons why you should be doing that. Within the mutual funds, there are two types of funds which are investing globally. Something what we call our feeder funds. The feeder funds essentially take the money here and they just take all of that money and invest in another fund outside India. The reason why they do that is essentially saying that instead of we trying to figure out how that market functions, which stocks to buy, there are experts sitting in those countries, let us just give the money to them and let them manage it. And there are some funds which are basically trying to do this buying and selling by themselves, directly investing in stocks as such. Now, how should one choose whether one should go to a feeder fund route or to these funds which are investing directly? Now, it depends overall how much you believe that the fund manager can provide you as value. There are some funds in India which have domestic portion and some portion which is invested internationally. Maybe for somebody who has not done anything like that, start with something like that, see how it behaves, how those funds are different, and then over a period of time increase your equity exposure into these international funds. Important thing to remember, two things, is that one, these still are equity investments, so these are not necessarily safe investments. These are equity investments like equity investments in India. Second, the taxation of international funds or these feeder funds happens as debt funds. So essentially, if you sell them before 3 years, they become short-term capital gains. If you sell them after 3 years, they become long-term capital gains. But the route that some funds have used is basically keep them under 35% of the portfolio, by which you get the equity taxation. So these are things to remember, but all in all, this is one category that we should have in our portfolio and something worth adding.
You mentioned taxation, and that's another point I wanted to talk about, because I understand that the tax treatment for these funds would not be like your regular equity mutual fund. So if you could elaborate on that, is this tax efficient?
So essentially, whenever one is investing in equities of any kind, whether locally or internationally, one should be thinking of at least 3 years or 5 years of investment horizon. That is what we keep saying this on the show. So now from that perspective, if I look, your equity mutual funds which invest more than 65% in equities in India, after 1 year they become long-term capital gains and you have to pay 15% tax. Whereas these funds, if you sell them before 3 years, they get taxed as per your tax bracket. So it could be 30% for people who are earning more than 10 lakh rupees. But if you hold them for 3 years and above, then it becomes debt taxation. So to that extent, you get indexation benefit. And so I would say if you are holding it for a 3-5 year horizon, basically the tax benefit pretty much balances each other out, so you do not need to worry about the taxation as such. But I think the diversification that it adds to your portfolio and basically just increases the overall reduces the overall risk on your portfolio, and without compromising too much on the return, because of which it is a very good addition to your portfolio.
Oh, then what about costs? Because from what I understand also, that there are certain feeder funds via which our Indian equity markets invest in. So there's this, would you say that there's an additional layer of fees perhaps in some of these funds, that we already have?
Yeah, so the feeder funds might have an additional layer of cost, though typically if you invest globally, or how the funds have basically going about this is that basically try to get a better deal for investors as compared to what local investors get. So you're not treated, basically the fund itself is treated as an institutional investor, so they get better rates. But yes, obviously there is a layer of cost which is added if you're investing it in two funds, because you're investing in a fund here, so there is some cost locally, and then this money gets invested abroad, so there is some other cost which is there. But I think for the benefit of what such funds provide, and the whole simplicity that you can access this with as little as say 1,000 rupees or 5,000 rupees a month, you can invest globally. I think it's all right to pay that slightly additional cost right now. But like I said, I'm thinking for somebody who's thinking about doing this, one needs to make sure that hey, you already have a decent equity portfolio in India and you want to sort of diversify away. But doing this through mutual funds sort of is very, very convenient. You don't have to think about okay, which country, how much, and what kind of stock. All of this is taken care of you by just investing maybe as little as say 2,000 rupees a month.